Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and guide you on your journey to financial freedom. I'm Josh Metal, and I'm here today with Dr. Peter Kim. Peter's a practicing anesthesiologist, the founder of Curbside Real Estate, founder of Passive Income MD, and a founding partner in Ascent Equity Group. Peter resides in Los Angeles, California with his wife, kids, multiple dogs, and like me, Peter is obsessed with creating financial freedom through multiple streams of passive income. So Peter, thanks so much for joining me on the show today, my friend.
Hey, I'm excited to be here, Josh. Thanks for having me.
Yeah, my pleasure, man. I've been a fan of yours. I've read multiple articles that you've written, and really love what you're doing in the income space for doctors, because I think most of the doctors I talked with are thinking about, index funds and kind of real passive investments. And you take a different, you've been drawn to a different path similar to me, which is more real estate and cash flow based. So that's what I'm really excited to dig in with you today. Your past is fascinating to me, from anesthesiologist to investor to entrepreneur. So just bring us up to speed. How did that evolution all come about?
Yeah, it was, thank you for that intro, first of all. I mean, I can tell you none of it was super intentional. Like people talk about, do you have something in your past where you learned all these things and you came up to this point? Honestly, none of it was what it turned out. I mean, what I planned it to be. My whole plan was to be a physician. That was it. Like growing up, as a kid, I grew up in a medical family. I just wanted to be a doctor. And that was my plan. And it's funny, like when you hit that point, you're like, all right, my life is going to be set. So I graduated from training and I'm like, this is it. I got my first job, my dream job. And I expected things to just be smooth sailing from then on. But what happened is about 2 years into my practice, a few things happened in my work. There's some political things. There's some things where ultimately my income and my time got cut. Without it just felt like I was not in control at all. I mean, I realized I was not in control. And back then, looking at it, I thought that was the most horrible thing in the world. I couldn't sleep at night. I was telling my wife, this is like, what's going on? But then it made me think about some other things. Like, all right, if this is how my life is going to be in medicine, like, what do I need to do now to make sure that I change things in 5 years, in 10 years?
Love it.
And so that's when I started to look at other people and I started to say, okay, what are other people doing in medicine to give them control of their careers and their lives? And I just started asking people. I mean, that's one thing about me. I'm not shy about asking people for help. I see somebody who's successful. I'm like, what are you doing? And it turns out that most of them were creating some sort of income stream outside of medicine. And that allowed them to practice in medicine how they wanted, to be able to create that ideal life. And so they were able to travel, spend time with their families, but still practice and have a smile on their face. And so I asked them, okay, I started digging in deeper. What exactly are you doing like for that income? Because I have no idea, because all I know is to be a doctor. And they said, well, most of them said they were investing in real estate. And I knew nothing about it. I started reading some books on it that they suggested. I started going to real estate investor meetings, went to like the forums online, Bigger Pockets, listening to podcasts, like, things like this.
Yeah.
And it just gave me like a basis and a foundation to get started. And I just became like, honestly, kind of obsessed about it. And I just started investing, and ultimately I started being able to create that income and that freedom that I talked about. And it was slow initially. It wasn't like all of a sudden it all happened at once. But that first like check came in where it's like, whoa, I made something outside of medicine. That was like the greatest, like one of the greatest moments,
Yeah.
And then I started just telling everybody about it. I started telling my friends, my colleagues, and I think like I talked to so many people that they were kind of like, hey, I don't have time for this right now, but if you would put it online for me, like package it nicely for me, I'll read it or this and that. I was like, okay, well, maybe I have to do this. And so I don't know, I'm not a writer, these kind of things, but I decided to start a blog that started as Passive Income MD. And that thing just continued to grow, became a podcast, courses, conferences. And ultimately that led me to where I am today, where honestly, I get to choose how much I want to work. I still work as an anesthesiologist, not as much as I did before. No more nights, no more weekends, this kind of thing. But I choose to work how much I want to work because I love it. I'm still passionate about it. But I also spend a good amount of my time now, obviously running businesses, figuring out like what kind of investments are good for me and helping other physicians also invest to create that cash flow and that income.
Great story. Did you have a moment where you read something or someone inspired you and all of a sudden you like made a decision that you could see this alternate path outside of medicine? Like, was there a defining moment that you can remember?
I mean, I do remember one moment where I was talking to a friend of mine who's a very successful surgeon in Beverly Hills. Nice area. I was at his house, very nice house. And I was talking to him and I was like, and he was like, oh yeah, this is a nice house, but I would really like to update the kitchen. I wish it was updated a little bit. And I remember talking to him and I said, well, why don't you update it? Then he's like, well, it's not my house. And I was like, what are you talking about? He's like, I rent this home. And I remember sitting there going, what? Why? How can you rent you're a successful surgeon. And I was like, why did you decide to rent your home? And he said, well, I rent my home here because it costs a lot less to rent the home than buy a home. And instead of taking that money and putting it in a down payment for my own home, I own rental properties all over the United States, which create cash flow for me. So honestly, I live here for free. And I remember that being a light bulb moment, thinking, there are people doing this totally different. I mean, all I'm thinking is I need to buy my own home. And this guy's thinking about cash flow and income, creating that freedom for him. And he's got these homes all over the US and apartments that he rents out. And I was like, it kind of like flipped the whole script upside down for me. And I remember thinking, okay, I got to figure out what he's doing and how he's doing it. And that's kind of started me on this journey.
I love it. I love finding people's inflection points where all of a sudden there's like this paradigm shift and they're like, okay, I can see it. I don't know all the steps between today and that future point, but all of a sudden it's like the light's been turned on and I can see an alternate path. And I love not only talking about those inflection points, but then, the courage to follow it, because a lot of people, I think, have those moments where they might open the door a little bit and see down this alternate financial future path, but then they just have a couple beers and call it a good day. And they never, like you said, you just got infatuated with it and you wanted to learn more and more and more. So I love hearing those stories. That was a good one. So just out of curiosity, and then I want to get into your 5 reasons you prefer real estate over stocks. So from that point, what was your first real estate investment? What was like the first real getting into the game?
It was a crowdfunding deal. Like, crowdfunding these days is really big platforms online where you get access to these real estate deals. And I remember going on to one of these things. I heard somebody speak at a real estate conference, one of the founders of it. So I said, okay, I'm going to check out your site. Went on it, found this deal where they were looking to raise a certain amount of capital for a fix and flipper. And that fix and flip property was actually in LA near my house. So I remember thinking, oh, that's a good area. That might be something to invest in, right? But you were investing on the debt side. So we were lending money out,
right?
Expected to get interest back every single month. And it was supposed to be a year long and you get your capital back. And I was like, okay, well, that sounds like a good way to start. And I remember thinking, oh, I don't want to put a lot in because I don't know what I'm doing. And the minimum there was $5,000. So I'm thinking, all right, I think I can do that. You know what I mean? I could put $5,000 for a year-long investment. I know that if I happen to lose that, it won't, cause my family to be in a lot of financial problems, but it's enough that it makes it a little bit more interesting. So honestly, I didn't know much about it. I invested in it. And I remember a month later, I got a check or something, a deposit really in my bank account for like $47, whatever it was. And I remember just being ecstatic. I was so proud of that $47. I remember I told my wife, I was like, I figured it out. Like I figured out a way to make money and not be, in the hospital. And I was like, that just kind of launched and catapulted me to just, find as many of these things as possible.
All right. So team, Peter just dropped a golden nugget and the $47 golden nugget. No, what you said that is so important in your story is that from the outside looking in on an investment, it's impossible for you to know everything. You can study, you can read, you can listen to podcasts, and at a certain point, you have to make an investment and watch how the thing evolves. And that first investment, the reason why I think it's so important to start young, I bought my first rental property with my mother as my partner, and I think I was 21. I was either 20 or 21. And it was a small step. It was a base hit. Maybe not even a base hit, it was maybe just a foul ball. But the point was we learned a ton. And you get in with enough money that if you lose, it's not catastrophic, but you're on base. And then you learn, and then you parlay not only those winnings, those savings, but you parlay the knowledge into the second hit, and it gets bigger and bigger. I think one of the mistakes that I see people making is not getting on base with that first $5,000 investment, and they're trying to learn from the periphery. And you can't learn that way. You got to get in the game.
Oh, I'm absolutely in agreement with you. I think a lot of people also feel that first investment needs to be a home run. So they just like keep searching for that perfect home run. But I tell people, like, oftentimes, like, it's probably not your first or second investment that really moves the needle for you. It's probably that third or fourth investment. So you got to get there, right? You got to get to that third or fourth one, because that's the one that's really going to truly start changing your life. But the only way to do that is get through 1 and 2. And on those, you want to learn, hit those base hits, kind of put yourself in a good situation. Obviously, you want to learn as much as you can before you dive in. You want to just dive in head first. But honestly, without those first couple investments, you're not going to get to the place where you need to be.
That's right. And also I see people, and I have this tendency, I feel like I got to be all in. Like I've got to put all my chips on the table or none of my chips on the table. And as I've gotten a little older with my investing, I realize there's a good chance I'm wrong. And I don't need to put all my chips on the table. I can just put a few chips on the table, see how that panned out, learn from the experience. And if I win, great, I'm up. If I lost a little. But the point is, get in. You don't have to go all the way in and swing for the fences, especially earlier in your investing career. Those are a couple of awesome nuggets, Peter. Thank you, buddy.
Mm-hmm.
All right, so let's get on to this article that you wrote. By the way, you said you're not a writer. I think you're now officially a writer, Peter, because you weren't a writer, but you wrote a great article titled 5 Reasons That You Prefer Real Estate Over Stocks. So I'd love you just to go through those 5 reasons and tell us why that is.
Sure. I mean, I think that most of us, we all, whatever's out there in media, everything you read, when you talk to financial advisors mostly, and a lot of them are great people, but they kind of know one way, and they know the way of kind of following the markets and index funds and stocks. And there's nothing wrong with that. I think it's one vehicle for people to get where they want to be. But for me, I realized if I wanted to kind of take control of my life now, live life how I wanted sooner rather than later, instead of waiting and building up this nest egg for 20, 30 years and expecting to be, the 20, 30 years from now, then retire. I was like, that's not the kind of life that I want. I wanted to start making action and taking control now. I realized that for me, real estate made a lot more sense, right, over stocks. And kind of comes down to these 5 major reasons that I love real estate over stocks. And the first one's the big one. I mean, it's cash flow. I think this one, if I just had one reason alone, this one would be good enough. And it's cash flow. I mean, that's the reason I invest in real estate. It provides essentially income replacement cash flow for me. And for me, it was about buying my time back and having those rental properties, investing in these passive deals that I invest in. It gives me monthly and quarterly cash flow that I'm able to use. And most of it's really tax protected, which is, we'll talk about tax benefits later, but it allows me to essentially buy my time back. It's what allowed me to work less weekends. It's allowed me to work less holidays, night call, which I was taking so much of. It's all monthly, right? A lot of it. That's what real estate's built, just like everyone pays monthly rent. And having that allowed me to budget appropriately. And honestly, it's totally changed the way I live. And that's the major thing. So we'll start with cash flow, number 1, right? Versus a lot of times in stocks, a lot of times there's appreciation and it grows in value, but you're not spitting off a lot of cash flow that you can use immediately. So that's number 1.
Do you mind if I ask you a quick question on
sure.
cash flow? Just in terms of vetting a deal, how does the cash flow on a deal help you decide whether you should invest in that investment or not? I mean, is that like the delineating factor of whether this is a good deal or not a good deal for you?
Well, that's one of the deals. I mean, I've learned now to put together a whole portfolio, right? Like you said, you don't go all in on one investment. You try to go into multiple investments, get that diversification. And so depending on what my portfolio looks like, I'm going for a mix of some cash flow, ones that cash flow a little bit heavier, right? But don't have as much upside later on. But then now I'm also, if I have a good amount of those, I also go for someone that maybe have a little less cash flow, but maybe have a little bit bigger upside to kind of balance out the portfolio. But either way, I want cash flow coming out of whatever investment that I do. And the reason is it kind of carries you through some good times, carries you through some bad times in case the market goes through some fluctuations. But also at the end of the day, again, it puts money in my pocket every month that I can use to ultimately live how I want to live. And that's the major thing for me.
The point I wanted to get to there, which you hit right squarely on the head, was that if you're in an investment and you have cash flow, the market sentiment of the value of that asset, meaning what somebody would pay for it, is meaningless, because as long as you're positive cash flow, you can wait out until the market changes its mind back your direction, what the value of that asset is. If you buy an asset and it's negative, I wouldn't call it really an asset at that point. Then if you buy an investment and it's negative, then at some point you may bleed out. And if you bleed out when the market values are down, you're in big trouble. That was the biggest lesson I learned going through the recession, as people were losing their houses to foreclosures and short sales. And I was like, well, yeah, some of these properties are upside down, but who cares? I'm still banking $300 in cash flow every month from this house. Why in the world would I get rid of it? So anyways, I just wanted to hit on that, and I appreciate you elaborating.
Yeah, no, that's a great point. I mean, really, like, you only lose money when you sell. So if this thing can ride you through market cycles up and down, that's one of the greatest lessons I also learned from a lot of these really experienced investors, is that you just got to set yourself up so you can ride through the ups and downs, and then ultimately decide if you do want to sell, you can. But if not, live off the cash flow and enjoy it, right? And then pass that along to your kids.
Well said. Well said.
Number two, one of the reasons I love real estate, it's an inefficient market. Now, what that means is that, the stock market, it's truly what they call, what I found is an efficient market, meaning that it's set up so well. I mean, there's so many people that are just watching this market, so many amazing buildings in New York that are just full of people who are watching this market, making sure that this market needs to be exactly where it needs to be. And you ride along with it as an investor, and you get to take the benefits of it being a growing market, an efficient market. But to be honest with you, the chance that you're going to find a deal in the stock market, with the information that you have, is probably slim, very slim. Now, I'm not saying it's impossible. I know some doctors who actually do this quite well. So that they focus and they study like 3 stocks, and they know everything about it, the ins and outs, and understand every aspect of it. But let's be honest with you, most doctors, most of us, we just know what the great stock is. We hear about it on CNN or whatever, CNN Money, and we go for it. To be honest with you, if you don't have the information before other people do, you're probably not going to be able to find that great deal. But I find in real estate, it's really different. I mean, real estate, as you know, like, there are so many people that are selling for many different reasons. Sometimes people that it's been passed along to them, they need to sell, they need that money elsewhere. There are opportunities for you to find deals and have a chance for you to capture a lot of that upside. For example, there are people who own properties forever. They don't want to renovate it. It's just too much of a hassle for them, but there's a lot of locked potential in there. Yep. And so you as maybe a little younger, hungrier investor is willing to come in there, do what's necessary to put in the work to get this to fully optimize investment, then you can actually get in there and do that. To be honest with you, now I actually like to invest with other people who are willing to do that, right? I don't love doing it as much myself, but I know there are people who do this full time, who go in, find these properties, have really this potential that's locked up in there, go in and are able to do that. And I invest a lot of times with them. And that's where a lot of this, actually, that's where it kind of leads to point number 3. Do you want to stop on that, or do you want me to keep going?
Keep rocking.
Well, that leads to number 3, where you can actually force what's called force appreciation, meaning that you can take some value of this property, put some time, energy, effort, capital into it, and make it a nicer property, increase what's called the net operating income, increase the value of it. There's ways that if you're smart, you can get in there and intelligent, and you can put you can actually force the value of that property to get higher. It's not like I can go in there, buy a stock. I mean, I bought, let's say Zoom stock. We're on Zoom right now. Like, I can't go in there, no matter how much we're using it. Trust me, I'm probably not going to be able to increase the value of it and increase the value of my investment. But when it comes to properties, there are great ways to do that, because honestly, like, it's just not being operated maybe to its optimal point. By finding good property management, there are ways to increase the value of that. All right. And number 4, it's the use of something called leverage. Now, Josh, I know you're well-versed when it comes to leverage, right? I think actually that's one of the most powerful aspects of real estate investing. And for real estate investors, if they're not using leverage, they're leaving a lot of money on the table. What I mean by leverage is a lot of times it's using debt, right, to purchase properties. Meaning that use a smaller amount to purchase a whole property. For example, like, you can buy $1 million property, put in $250,000 or $300,000 to own an asset that is worth $1 million. And if that property goes up in value, you capture the full upside when you only own a small percentage of the actual building. Now, this can really result in really outsized gains. Of course, there's a downside to it, so you have to be careful. Like, as it multiplies gains, it can also multiply losses. So you just have to use it responsibly. But I think in real estate, there are ways to do that. If you don't, just bite off more than you can chew, take, a good amount of debt and amount of leverage and use that responsibly. There are ways to really take advantage of that. Like when you invest in stocks, I think you can do some of the same. You can do, buy some things on margin. Let's call. The problem is when you buy things on margin, what happens is sometimes if that asset value starts to drop a little bit, they're going to call that money on you. Meaning that you got to either produce that money by either liquidating your stocks or bring more money to the table. Whereas in real estate, you can ride that out. As long as you can manage those payments, you can ride through that whole period with cash flow that we talked about. It's a great long-term ultimately it's a great long-term kind of play for people to use leverage and ultimately get amazing returns from it.
I'd like to comment on that if I could real quickly, because I think that this is one of those phantom generational wealth building effects that some people have a hard time visualizing until they're in the game and they've made their first investment or maybe a couple of investments. So, Utah had an incredible real estate appreciation year, and I hope it will slow down because it's frantic right now. The home builders can't keep up, but we had 12% appreciation rate over the last year, which is unbelievable and actually uncomfortable. It needs to slow down. But the point is this: if somebody bought a $1 million house and they put 20% down, they have a $200,000 cash outlay. The real estate appreciated at 12%. But so let's say the value of the house went up $120,000, but that's not a 12% return because you didn't put $1 million in cash in. You only put 200,000 in. So if you put 200,000 in and your appreciation went up 12% or $120,000, that's a 60% return on investment. 60% return on investment on a 12% appreciation. And I don't think most people think through return on investment. They just look at, I've heard before from financial advisors, well, real estate appreciates at roughly inflation, 3 to 4% a year. And stocks appreciate on the S&P 500 going back, into an infinity at 8% per year. So your money should be in stocks. Whoa. The appreciation's on the whole asset in real estate, not just on the capital that you bring to the table. So this leverage piece is massively important.
Yeah, no, I mean, we should be doing a whole podcast just on the leverage part, right?
Yep.
I mean, that's where you're part of. I mean, that's where the magic happens when it comes to leverage. There are so many different ways to use leverage to work well. I know that there's a lot of, there's definitely a movement out there in certain circles to be totally debt averse and not use leverage at all. And I understand that there's some sort of, there's an emotional, mental benefit to not having a lot of debt. But I think debt isn't necessarily something you should have to be scared about, right? I think I talked about it before on a different podcast. Like, let's say you make, your debt payment's $10,000, but you make $20,000 because of that debt payment of $10,000. You're making money and you're doing well. And that can create financial freedom for you, even if you have debt. And so definitely that leverage piece is really important for people to understand. And it's something that honestly, it's still something I'm learning and trying to get better at. All right. So the last thing is, again, I could spend a whole nother podcast on this one. This is tax benefits. I mean, to me, it's like the real estate code. The IRS code is kind of written to incentivize people to invest in real estate. It's like almost like they're telling you, please invest in real estate because there's so many tax benefits available for people. And, talking to my CPA who invests with a lot, he works with a lot of real estate investors. He's like, it doesn't make sense for people not to invest in real estate because the way especially high net worth individuals that are that are making good incomes, because it's set up for you to create a lot of tax shelters, get a lot of cash flow, create appreciation, and all in a really tax protected manner. And I don't want to go into all of it right now, but there are ways that the government helps you write off so much per year. There are exchanges you can do where you can have like tax-free exchanges to kind of keep those gains, from actually, spitting off capital gains taxes. And so there's just a lot of benefits to it and allows you to compound basically your returns a lot faster. And again, real estate, a lot of these investments, none of it's going to be like get rich quick type stuff. But as we know, compounded gains over time is what the real power, in this whole thing. And so if you're able to compound gains without paying taxes on it, I mean, it just accelerates and accelerates your net worth and your gains over time. So those are the 5 ones. Hopefully I went through them not too fast, but honestly, those are the reasons I love real estate over stocks.
Yeah, well, we'll give a link to your blog if people want to go deeper and read the article and get more of your writing. But I 100% agree with you. And the tax benefits are absolutely incredible. I remember reading Rich Dad, Poor Dad by Kiyosaki, and he talks about the cash flow quadrant and that realization in my mind, oh, wait a minute, if I'm earning income from an investment property, I'm paying a lower tax rate than if I'm W-2. Like that was like a really, eye-opening thing for me at that time. And looking back on it now, if you really get into it and you get qualified as a real estate professional, which means you or your spouse spend a certain number of hours working on your personal real estate investments, there's a whole nother arena of tax deductions that are available to you. And now, Peter, I don't know how you look at it, but I either look at it, I get to the end of the year and I'm like, okay, it's October. We either buy another building or we write a big check to the IRS. Yes. So it's either going to Xander and Arya when we die, or it's going to the IRS. What do you want to do, babe? And she's like, oh gosh, not another building. Okay, let's do it. But that's really the game. It's almost like Donald Trump had something to do with the tax laws or something, because it definitely is accommodating to real estate investors. Hey, you mentioned one other thing, that I just kind of echoed as well. Somewhere in this five reasons you prefer real estate, you mentioned something about passing it along to kids. And I'm curious to dig into that a little bit. What's your viewpoint on your real estate investments, and how does that play into your view on passing it on to your kids?
I mean, obviously it's really important for me to set up my kids for success. At the same time, to be honest with you, like I hope by the time I pass along anything to my kids, they won't actually even need these properties. I hope I set them up well in terms of obviously their education and all that stuff. I hope to live a long time. So if I'm, at this point, 30 years older than them, by the time I pass on, I hope that they're financially stable and that sort of thing. But like when you look out there, that the greatest, wealth, generational wealth, a lot of it comes from real estate. It gets passed along, at least the way the laws are written right now, with a step-up basis and that sort of thing. It's engineered to really kind of pass along wealth to the next generation and the next generation and that sort of thing. That is definitely a legacy component for me that I would be happy to pass along to future generations. At the same time, again, it is not the primary driver for me. I think for when I talk to my kids and all that stuff, like the primary driver for me is to create that time so I can spend with them now. Like that's my primary goal. I love that. I want to spend time with them now. I would love to be able to pass stuff along to them, but that's in the future, right? Creating that time, freedom for me, being present for them, especially with what's going on now. Like it's meant all the world to me. And this is something like I just feel so fortunate to have been able to spend as much time as I have been with them. And a lot of it's done because of the cash flow that's come from real estate. So I'm just so grateful for that.
Well, I think you struck on something that's really important. The greatest inheritance in the world, I believe, is the inheritance of knowledge, and to teach them how to be, successful on their own. Back to the tax benefits, in my mind, the master plan here, the master trick is you parlay your real estate gains from one property to another, trading up via 1031 exchange, and you escape real estate taxes and income taxes that way. If you create cash flow, which is taxed at a lower tax rate. If you need capital, instead of selling a property, you take out a loan against the property, which, by the way, is 100% tax-free. So now I have tax-free capital to live or other investments. And then ultimately that property gets passed on to my kids, and it does so at a stepped up basis. Peter, do you want to explain what a stepped up basis is? Because that might go over a few people's heads.
Yeah. I mean, I just assume, with the words, this is with any of your assets, I guess, when you pass. But what happens is that, let's say you've deferred taxes again and again and again. At some point when you sell that property, typically you've got to pay taxes on your gains.
Yep.
Now, what happens is when you pass, at least the way the law is written right now, when you pass that along to your kids, your kids essentially get that property essentially at the current market value. And so if they were to sell that day, like immediately when they got that property, essentially they wouldn't owe any taxes because it's like they got it at the value that you sold it. For example, let's say a property is $100,000 when you bought it. It goes up to $1 million. Normally, if you sold that property, you'd have to pay capital gains tax on it. But if you pass that along to your kids at $1 million, it's like they bought that home, or bought that property at $1 million. And so moving forward from there, the gains are based off that $1 million. I hope I explained that okay. But essentially, that's a beautiful thing about real estate and passing along. And that's why there's so much generational wealth in real estate families that you see, over multiple generations, because it's just getting passed along essentially tax-free to the next generation. And so that's a powerful tool. And that's a way, again, if you feel like your legacy is also kind of setting up the next generation, that's one amazing way to do that.
Yeah. And virtually escaping taxes, right? I mean, I bought the property, I depreciated it and took tax deductions over time. I borrowed against it if I needed more capital to invest. That's where it's tax-free. And then it passes on multi-generational to the next generation without taxes. I mean, that is the master's program to make sure you have money left at the end of the day, is to use every possible IRS code advantage. And real estate has more than any other game I'm aware of.
Mm-hmm.
So, dude, let's talk a little bit about inflation, because that seems to be the hot topic with the economy reopening and, M2 money supply going sky high, 30% increase. I mean, this is a really interesting time in economics. So how do you look at inflation as it pertains to your real estate and your debt on that real estate?
It's funny that you talk about that, because it was just a day or two, I think, that was released, right? Where the consumer price index was released, where essentially they show that the cost of goods actually took a big leap.
Hugely.
It took a huge leap, versus it's been pretty stable for a while. For example, I guess people always talk about how much does milk cost, right? And that's like one of the major metrics that people use, like how much does the cost of milk increase over time? I mean, essentially what they're saying is it increased a significant amount over the past year. And that's not surprising because there's just been so much money that was printed. It's funny. My father-in-law talks about that all the time. He's just like, money doesn't mean anything. The dollar doesn't mean anything these days. Like, he's looking at it over history. And it's like over time, that dollar, what it can get you, just seems to be degrading over time. And he thinks that, I think a lot of people think that because of the amount of money that's been printed over the last year, which was necessary to keep the economy going, they think that the value of that money in circulation now is becoming less and less over time. So when I talk to people, much more people than me, like my CPA, I ask them, like, what is the strategy here? And what he's telling me is that you don't want to hold on to that cash. He says cash is trash, is what he told me, actually. So that cash, the value of it sitting in your pocket, imagine there's a hole there and it's just parts of it are just kind of flown out of your pocket over time. You want to have it in some sort of asset that is appreciating over time. Hopefully one that's in line with inflation as these prices go up. The value of your whatever your asset is, and real estate over time is shown to be that, like, a perfect asset for that. Like, as prices go up over time, real estate goes up over time, rents go up over time, and that kind of thing, and everything kind of falls in line with that. And so having an asset like real estate is really, really great in a period like this. Now, also, if you have debt on the real estate, meaning you borrow money for it at a certain percentage, having inflation like along with that debt, it's almost like it's like wheedling away at your debt as well. So the value of your debt, for example, like I don't know. First, I'm looking at rates now under 3% for some properties, right? Or 4%. I mean, my own home loan, home loan as well. Actually, I'm getting it at 2.125%.
It's amazing.
And so it's amazing. I mean, the numbers are crazy. My student loans are like at 1.8%, actually. And if you think about the dollar, like, an inflation's going at like 3 or 4% right now. If you're sitting under that value, you have debt that's under that value, essentially you're kind of making money in a weird way by holding on to that debt. Again, it's some concept that I've had to actually try to understand over time, but it's nice to have debt is what he's telling me. So what my CPA tells me is that he's like, all the smart people are actually, they want to hold on to as much debt as possible right now, especially on their own home. They're telling me, like, your own home, like, you want to have as little money as possible in your own home, have that in rental properties, have that in investments as much as possible, hold on to that debt while inflation right now seems to be increasing. And that seems to be the strategy for a lot of people, and one that I'm trying to employ as well.
Yeah. Do you know who Jason Hartman is, Peter?
No, who's Jason Hartman? I've probably heard the name before.
Yeah, he has a incredible real estate podcast, and he does a lot of real estate coaching. I'll send you a link to his website. And actually, I did a podcast with him, so I'll send you the podcast. But he has this term called inflation-induced debt destruction. And basically, he just put a name on what you described and your CPA described perfectly. And essentially, it's this. If Peter Kim takes out a mortgage loan at 2.125, but inflation goes to 3%, that debt now becomes an asset because the rate of inflation is eroding the value of the debt. And Peter took his dollars, put it into another piece of real estate. Instead of Peter paying cash for his home, he took those dollars and he put it in another investment that, assuming, is going to appreciate greater than the rate of inflation. So he's got his money working over here beating inflation, and his mortgage debt is now at a lower interest rate than inflation, which means each year it's eroding. So the debt now becomes an asset. And that's the inflation-induced debt destruction. And I know this is a podcast, but I want to share my screen really quickly and just show you this, Peter, because I think you'll think this is cool. So check this out. In 1971, right, 50 years ago, a new house was $25,000. The average income was $10,622. A car was $3,500. Average rent in America was $150 a month. Tuition at Harvard was $2,600 a year. A movie ticket, $1.50. Gasoline, 40 cents. Where's milk on here? Milk's got to be on here. Nope, no milk.
Yeah,
there it is.
Like fun. Yeah,
117 a gallon. So the point is, Peter, check this out, right? If we have an opportunity to borrow money, at a constant rate, meaning the cost of that money is 2.125 for however long you borrow that money, the cost is the same, but the value of the money changes. The value of the money goes down. So do you want to pay that debt down? Do you want to pay that debt off, or do you want to lock in the rate and string it out as long as possible? Because the average income in America has gone up a lot from the $10,622 that it was in 1971. You want to pay that debt down over a longer period of time when the value of the dollars you're repaying the debt with is lower.
Yeah, that's a great lesson. I love that term. I'm going to check that out. I might use that somewhere in the future as well, because I think that describes it perfectly. It's awesome.
Yeah, there's a page on his website where he actually did an illustration over 30 years and shows the cost of the money, the amortization, and then the value of the money. It's fascinating. So I'll send you that. This is fascinating. I've loved this conversation. So let's get tactical here. I want to actually pivot away from the whole real estate investment and get a little bit more into your entrepreneurial ventures. So, and how do you look at investments in businesses you control and have influence over as compared to passive investments in stocks and bonds?
Yeah, I think it's a really interesting thing. I mean, I didn't expect to become an entrepreneur. It's something that, just kind of came about over time. I mean, I was just opportunistic and just opportunities came about. And there's, of course, building my own businesses as well. But it's also what I've started doing is understanding that, all right, I do have some influence. I do have some experience now. I do have some capital and these kind of things. And so, I don't have as much bandwidth or, myself, but I can help other businesses to grow as well. And so I think this is what you're referring to, is that I started investing, especially in other people's businesses as well, like in terms of angel investments, small partners. For example, I found ways that I could utilize my own kind of network and what I already have built to help them grow. And that helps everybody out at the same time. For example, I do have a blog and a brand, and I have some, an audience and that sort of thing. And so I also became an investor in another blog and another brand talking about a lot of financial stuff for physicians. And I'm able to use my network and my connections to help them grow and build up their business as well. And so it benefits both of us at the same time. That business grows, my investment grows, but I'm also able to pass along that knowledge and the other resources that I have. They're able to leverage what I've already built to be able to grow themselves as well. So that's one of the businesses that I've invested in. I've done a fair amount of angel investing, and in the beginning, I just did it because, whatever business sounded like a great idea. I'm like, that's a great idea. I'll invest in it. But I had no really way to influence that investment. I had no way to actually participate in it. I just think it sounded like a cool idea. All those investments have done horribly. I'll be honest with you. They've done well. I mean, you hear about this. Doctors are notorious for doing this. They hear about a cool thing. And honestly, just enough to be dangerous. So I'm like, that makes sense. But there's so much more to a business than just the idea. Like the execution matters a lot more, right? So now what I've realized is that I'm not going to invest in a business unless I can actually influence it in some way to help them increase their value, their business, and that sort of thing. Whether it's offering my experience, my knowledge, or honestly using what I already have to help them, right? For example, I have invested in certain real estate type companies, real estate tech type companies, and I can help them because I have an audience that loves that kind of stuff. And so if I can help them grow their investor base, for example, then using my audience, and I think it's a win-win, then everybody wins at the same time. And so that's how I've kind of really participated in a lot of these businesses and at least invested in these angel investments is, again, I have to know that I can at least contribute somehow to growing their business and their bottom line.
Yeah. I asked that question because I've seen in some of the people, some of the loan officers that I coach and some of the people I've spoken about finances where they, for some reason, feel a lot more comfortable putting money into the stock market than they do a business investment or opportunity that they would have some degree of influence over. And I think that's backwards. I think that for example, we just launched partnered with a company to launch an insurance company. We homeowners insurance company. We did that because we knew that company could deliver a very high level of service, great rates, and we have the opportunity to make introductions to those people. We're dealing with mortgage clients all the time that want a second opinion on insurance. And we have an opportunity to solve two problems at once. One, we can give our clients a second opinion and maybe some different perspective on their insurance. And two, we have the opportunity to invest in that company that we have influence over, and we can actually influence their level of service to our clients. So it's like we get to serve both purposes at the same time. So I agree with you. If you can check multiple boxes and you have influence, to me, that's a lot safer place for my money than an index fund or something like that.
Yeah, I mean, even my wife's getting into it. She's a physician as well. She's an ophthalmologist, and she has a very good social media following. She does a lot. Her name is Vicky Chan MD, if anybody wants to follow her. But she talks a lot about healthcare type stuff, and people follow her for that. And we had a chance to partner with a custom 3D printed glasses company.
Wow.
Who's providing amazing service for especially children who children's glasses are hard to find and they don't fit well and they grow and this kind of things. And so they created this 3D custom kind of proprietary algorithm on their iPhone where they can map your face and create these great cheap glasses for kids, right? It's called Kids Frames. And we love that concept because our kids were, they don't need regular glasses, but we were doing the blue light lens, these kind of things. Yeah. And honestly, you could sit on them, they could snap off, but they don't break. And so we're like, all right, this is a company that we can actually get behind their mission. We know that we met the founders. We can influence it in some way because we'd love to promote these because, we had difficulty. We've had friends who had difficulty getting glasses. And so this is a perfect company that we want to invest in and be part of their company. And that's kind of like a company, for example, that we invested in, that we've been helping to grow and that sort of thing.
Yeah. And back to your previous point, Peter, I think the mistake that I see dentists, doctors, medical professionals make is back to that home run idea that they don't make these investments for a long time. Then they save up a nest egg. They feel safe because now I've got a bunch of money. And now they're going to make a $500,000 investment, but they never made the $5,000, the $10,000, the $25,000, the $100,000 investment. And they didn't gain all that financial literacy and IQ through those bad investments. And by the way, half of those beginning investments are not going to go well for you. I mean, that's just, at least that's been my experience. I had to cut my teeth. And then once I get to the 500,000, the $1 million investments, I've learned all of those pitfalls and I make so much better decisions. So again, it's getting in early enough with money that you're okay to lose so that later you can make big decisions and big commitments and have a track record to look back on and a different perspective.
Yeah, I'm with you on that. I consider a lot of those early investments. I mean, again, the goal is more education, to learn from them, to grow. And if they happen to make money, then that's even a bonus. I mean, you don't ever want to lose money. But same with my own first apartment building. I actually went through it with a partner and we said, look, this is going to be our MBA in real estate education. Like if we happen to lose money, at least we're going to learn and it can be a tax write-off is what we said. And it turns out that has been an amazing investment, but we didn't necessarily go into it with that, but it's turned out to not only give us education, knowledge, it's helped us actually get into other investments. So honestly, like you just got to get started.
Yeah. Do you know who Dr. Carol Dweck is?
Oh yeah.
Yeah. So it's the whole growth mindset thing, right? It's the not yet mindset that I don't know all those things yet, but I'm willing to make a mistake. I'm willing to reiterate and improve and continue down that path. Mm-hmm. Love it, buddy. All right. Well, I know it's a great podcast when we run out of time and I have 5 more questions for you. So I'm going to skip to the last question I have for you because I think we've pulled a lot of value out of here. If you had one book or maybe even one author that made a profound impact on you and kind of changed your trajectory or made you shift your perspective, what would that author be? What book would you recommend people check out?
I mean, I just feel so cliche in the real estate world to mention Rich Dad, Poor Dad, but I know so many people have just said that, but it truly was Rich Dad, Poor Dad. Yeah. And it's funny because I tell people, like, I have 2 fathers in my life, my dad and my father-in-law, and they're both in medicine. Both started at the same time, both at very high lucrative careers. Totally different outcomes for them when it came time to retire. Why? Because they both made a lot in the 80s, in the prime time of medicine. And really it was because one started building assets, started investing in real estate. The other one just went the basic plain road where they had high salary, made a lot, but then spent a lot. And totally different outcomes. I was able to see it play out in my own life. And it was like the Rich Dad, Poor Dad story. When I read it, I was like, this is my life. I mean, I see it now and how it's played out in reality. And so that honestly shifted my mindset in terms of, the whole, the cash flow quadrant, physician is a high net worth individual, make high income. But honestly, we're honestly just a slave to time. I mean, we're just a highly paid hourly worker. And when you stop going to the hospital, that faucet closes off as well in terms of income. And honestly, you're not in a better situation than you were before. And so it's so important to create those assets, create cash flow outside of medicine. It totally changed the way I thought. And honestly started me down this path to where, like I said, the path of financial freedom, creating that cash flow and where I am today. I'm so grateful to have read that. Honestly, I think it's like a $6 book now or $11 book. And honestly, it's worth it for everyone to at least read once at least.
So it's funny. I was listening to an interview by Robert Kiyosaki's wife, and darn it, I can't remember her name. I'm so sorry.
I think it's Kim.
I think it is. It is Kim Kiyosaki. She's brilliant, but I mean, she's phenomenally brilliant, by the way. And she said that they sold more copies of Rich Dad, Poor Dad in 2020 than they ever have in any year before. And I think the book's been out for like 30 years or something. So I'll just piggyback on what you just said. If you wanted to take a quantum leap forward in your financial literacy, just do 3 things. Number 1, buy Rich Dad, Poor Dad. Number 2, buy the cash flow quadrant board game. Play that with your kids. It's a blast. It's literally how to get rich. It is phenomenal. And then number 3, you got to go to Peter Kim's blog and you need to check out his products and writings there. So Peter, if people want to find out more about you and the products and services you offer, where can they find you, man?
Yeah, I mean, the hub of everything is my website, passiveincomemd.com. We have a bunch of Facebook groups for physicians and non-physicians just to talk about this stuff. We do hold a couple conferences every year, virtual summits that are absolutely free for people who want to join. Well, our next one's going to be in September. It's going to be called the Financial Freedom Through Real Estate. Look out for it. Again, it's a free virtual summit for anybody who wants to participate in this. Our mission is to get this out to as many physicians, healthcare professionals, high net worth individuals as possible. Because I think ultimately, healthcare and our society will be better for it. You've got doctors and people in medicine who want to be there and feel like they're doing it because they're passionate about it. I mean, that changes the world to me, in my opinion. And that changes the way we treat patients. And honestly, it kind of just kind of, drips down and just helps everybody out. So check that all out, and excited to figure out how I can serve anybody on this. If you're listening to it, feel free to reach out.
Peter, you're a total stud. Really appreciate you. You got a giant heart, man. And thanks for what you're doing for the world, brother. Thanks for listening to the Infinite Financial Freedom Podcast. Subscribe to us on Apple Podcast and Spotify to be notified of all future episodes, and follow us on social media to join in on the conversation. If you'd like to learn more about Neo Home Loans and how we empower homebuyers with financial literacy and guide you on your journey to financial freedom, visit neohomeloans.com.